Here's a handy hint for commercial and multifamily real estate owners. If you've owned your property since 2014 or earlier, and you've incurred substantial costs to repair or renovate it, chances are you may be able to obtain some very sizable tax deductions. How? First off, most accountants are going to recommend capitalizing and depreciating your major renovation and repair costs. If your accountant did that, they were correct in doing so. That is, if those costs occurred before the regulations changed in 2014. After that, everything changed dramatically, and there are now complex new rules to determine whether costs need to be capitalized or may be expensed. Now, the good news is that in many circumstances, the rule changes favor you, the taxpayer. Under the new rules, many big-ticket costs, such as a new roof, might be eligible for immediate expensing rather than having to depreciate the cost over many years. One exceptionally valuable aspect of the new regulations is this. The new definitions of expenses, which are in some cases quite liberal, can be applied retroactively. That means a cost you incurred in the past might now be reclassified from a capital expenditure, which is being depreciated slowly over 39 or 27 and a half years, into an immediate expense that you can deduct from your taxable income. Suppose, for example, you renovated the swimming pool area of your hotel, or say you own an office building and you tore out old tenant improvements and put in comparable but new ones for a new tenant. You might be able to expense much or all of those costs under the new rules if they meet certain tests. For real estate owners with smart and motivated tax accountants, I've seen these new rules create some dramatic deductions and tax savings. Now, I work with a few of those CPAs. One of our mutual clients had us perform a study of several buildings to identify qualifying assets to decapitalize. They ended up saving $4 million in income taxes last year. If your accountant hasn't talked with you about this, you may be missing out on potential tax deductions that you'll only get slowly over 39 years rather than today. How can you tell? The place to start looking is your depreciation schedule. Have it reviewed by someone knowledgeable about these regulations and about building construction, repair, and maintenance practices. A cost segregation firm is an example of where this expertise can be found. Should you decapitalize parts of your building? Contact me for a complimentary review of your records to see if this might work for you.